Hello and good evening, everyone. My name is Yasir Gulfraz, and uh, I'm happy to welcome you to your first lecture on Introduction to Economics and Accounting. So, over the course of the next four lectures, we will explore the fundamental principle of the subjects, understanding how they apply to business decision making and financial management. So now let's begin to our journey into economics and accounting. Unit aims. The aim of this unit is to provide learner with an understanding of the basic principle of accounting and economics within business environment. Also, learner will develop an understanding of the content of basic financial statements and the principles of recording financial transactions. Any question, if anyone is there? Okay, there are two main indicative contents from economics to accounting and concepts and conventions in accounting. Uh, Here, quickly we'll look at key terminology, economics terms, demand and supply, GDP, fiscal policy. Uh, as you know, that relationship between the availability of goods, which is supply, and consumers' willingness to buy them demand. Gross domestic product, total value of goods and services produced within a country in a given period. Fiscal policy, government policies on taxation and spending to influence the economy. Monetary policy, central bank policies to control money supply and interest rates. Accounting terms, if we talk about accounting terminologies, profit, net income, revenue minus expenses, balance sheet or financial statement, which shows a company's assets, liabilities, equity at a specific time. Income statement, financial report showing revenue, expenses, and profit over a period. Cash flow statement, statement showing cash inflows and outflows in a business. Accrual accounting, recording revenues and expenses when they are incurred, not when cash is exchanged. Any questions so far? If anyone is there. So, video, I will encourage you all to watch a short video on Introduction to Economics. So, this here is the link, and this video will help reinforce the idea we discussed and give you a visual perspective on how these subjects apply in the real worlds. So, you can, if you want to check, you can click and check. You can visit the link. So, understand essential aspect of business accounting. So, let's break down the essential aspect of business accounting in a structured way. Definition and purpose of business accounting. Business accounting is the systematic process of recording, analyzing, interpreting, and presenting financial information. In simple terms, accounting helps businesses track their financial activities, ensuring they remain profitable and sustainable. So, why is accounting important? Well, imagine running a business without keeping any records of your income and expenses. You wouldn't know whether you are making a profit, a loss, or a loss, how much money you owe, or whether you have enough cash to pay your employees. So that's where accounting comes in. It provides a structured way to monitor financial performance. Purpose of accounting, the primary purpose of accounting is to provide accurate financial information to key stakeholders. These include business owners, investors, creditors, and banks, government, and tax authorities. So, next we will talk about fundamental principle of accounting and types of financial statement. When we talk about fundamental principle of accounting, these principle from the fundamental foundation for all accounting practices and ensures consistency, reliability, and transparency in financial reporting. One of the most important principle in the accrual basis uh, uh, is the accrual basis. So, unlike cash accounting, which records transactions only when cash received or paid, the accrual method record income when it is earned and expenses when they are incurred. Uh, Regardless of actual cash flow, this approach gives a more accurate financial picture of a business. Next, consistency. Consistency, which requires businesses to use the same accounting methods from one period to another. This ensures comparability, making it easier to analyze financial performance over time. Materiality includes all relevant information that could impact financial decisions. Uh, Prudence emphasize caution in financial reporting. This means businesses should report expenses and liabilities as soon as they are probate. But income should only be recognized when it is assured. So, this principle prevents overstatement of profits and ensures conservative financial reporting. So, lastly, we have the concerns principle, which assume that a business all continue to operate indefinitely unless uh, there is clear evidence to the country. This principle justifies why companies record long-term assets and liabilities without assuming liquidations. Type of a statement, financial statement, income statement shows expenses, income, and profit over a certain period, uh, highlighting a business profitability. Balance sheet basically balance sheet shows three main things: asset, liabilities, and equity or capital within a given time, reflecting the financial stability of the business. Cash flow statement. Cash flow statements, which tracks cash movement in and out of businesses, unlike the income statement, which includes non cash items like depreciation. The cash flow statement focuses purely on liquidity. Uh, Statement of changes in equity reflects changes in the owner's capital or equity over a reporting period due to profit, losses, dividends, etc. Key components in business accounting: assets. Uh, Anyone can tell me, if anyone is there, what assets are? Okay, every business has assets which are resources owned by the company. These include cash, inventory, property, and equipment. Liabilities, which are financial obligations such as loan, accounting payable, and other debts. Equity or capital represents the owner's interest in the business after deducting liabilities from assets. It reflects the value of companies and belongs to its shareholders or owners. Revenue, income generated from business operations, for example, sales, services, or fees. And finally, expenses, which include wages, rent, utilities, and other costs needed to run the business. Financial ratios and analysis. Here we'll talk about liquidity ratios, profitability ratios, leverage ratios, and efficiency ratio. So, liquidity ratio means a company's ability to meet short-term obligations. Uh, for example, the current ratio, current assets minus current liabilities, indicates whether a business can cover its short-term debts. The quick ratio is a stricter test of liquidity, excluding inventory from assets. Then profitability ratio assess a company's ability to generate profit. Some important ones including gross profit margin, return on assets. Next is leverage ratios, indicate how much a business relies on debt. Uh, For example, the debt to equity ratio compares total liabilities to equity, helping investors assess financial risk. Then efficiency ratio evaluate how well a company utilizes its resources. Inventory turnover, for example, shows how quickly inventory is sold, while receivable turnover indicates how efficiently a business collects payments from customers. Any question so far, if anyone is there? Okay, so role of accounting in decision makings and ethical consideration. Accounting. Accounting is not just about compliance, it is power decision making tool. First, budgeting and forecasting are essential for planning future expenses and revenues. Businesses use past financial data to project future performance and set financial goals. Accounting also helps in cost control and management. By tracking expenses, businesses can identify areas where cost can be reduced without affecting efficiency. When it comes to investment decision, financial data supports decisions and investments, expansions, and new project launches. Tax planning and compliance are important to avoid penalties and legal issues. Proper accounting ensures businesses pay the correct amount of tax and taking advantage of tax saving opportunities. So, ethical consideration in accounting, ethical with consideration is accounting with great financial power comes great responsibility. So, ethical consideration in accounting ensures trust, fairness, and legal compliance. Transparency and honesty are fundamentals in financial reporting. Manipulating financial statements to show inflated profits or hiding liabilities can lead to serious legal and reputational consequences. Compliance with accounting regulations such as GAAP, Generally Accepted Accounting Principle, or IFRS, International Financial Reporting Standard, ensures consistency and fairness in financial reporting. Accountants must also avoid conflicts of interest by maintain objectivity. Financial reports should never be altered to benefit personal interest or mislead stakeholders. Any questions so far? If anyone is there, accounting software and technology. So popular accounting software like QuickBooks, Xerox and Xero and SAP help businesses out auto, automate financial transactions, generate uh, reports, and manage accounting within hours. So benefits improve accuracy, time saving, and ethical accessibility of financial data. Challenges: there are still some challenges, requires training, security, uh, data security risks, software training, and regular updates to stay compliant with evolving standards. So, conclusion for this section is to summarize business accounting in the foundation of financial transparency and strategic decision making. Without proper accounting, business would struggle to understand their financial health, comply with regulations, make informed decisions. By applying accounting principle, analyzing financial statements, and using modern accounting tools, businesses ensure sustainability, profitability, and long-term success. So, any questions so far? If anyone is there, especially regarding this section. Okay, what is an accounting? Any idea or any comments on this if anyone is there? So accounting is often referred to the language of business because it systematically records, classifies, summarizes, and interprets financial transactions. But why is the important accounting provide important information that helps businesses, owners, investors, creditors, and regulatory authorities make informed decisions, whether it's tracking financial performance, ensuring compliance with laws, or preparing financial statements such as income statement, balance sheets, and cash flow statements. Accounting plays a vital role in financial management. Through accounting, businesses can measure profitability, evaluate financial stability, manage resources efficiently, and plan strategically for future growth. Without accounting, organizations would struggle to make sound financial decisions and operate successfully in a competitive business environment. Explain a range of common accounting term assets we just discussed above, or resources owned by businesses that hold economics value and are expected to benefits future operations. They can be current, short term, or non current, long term. Cash, inventory, equipment, building, and patents. Then next is liabilities. Liabilities represent the financial obligations of a business, meaning the debts or money it's owes to external parties. These obligations must be settled over time through payments or services. Uh, Examples: accounts payable, bank loans, bonds, and accrued expenses. Common accounting terms: equity and revenue. Equity, also called owner's equity or shareholder equity, represents the owner's stake in a company after deducting liabilities from assets. In simple term, it is the net worth of the businesses. Revenue, often referred to as sale or income, is the money a business earns from its normal operations. It is considered the top line of the income statement because it appears at the very beginning. Major example is sales revenue, service income, and interest income. Expenses and profit. Expenses are the cost incurred by a businesses in its day-to-day operations to generate revenue. These can be categorized as operational expenses, non-operational expenses, interest payments, taxes, cost of goods sales, direct cost of productions like raw material and labor. Profit is also known as net income. Profit or net income is the amount that remains after all expenses are subtracted from total revenue. It is an important measure of a company's profitability and financial success. It is also referred to as the bottom line of the income statement. Uh, Major examples are net income, gross profit, and operational or operating profit. Here, gross profit and cost of goods sold. Gross profit is a key indicator of a company profitability. Before considering other expenses, it is calculated using the formula, which is gross profit is equal to revenue minus cost of goods sold. So, cost of goods sold refers to the direct cost associated with producing goods or services. It includes materials, labors, and manufacturing costs. Businesses aim to minimize cost of goods sales to improve profitability. Examples: raw material cost, wages for productions, workers, and factory overheads. Account receivables and account payable. Account receivable refer to money owed by a business by customers who have purchased goods or services on credit. It is classified as a current asset on the balance sheet because it is accepted to be collected within a short period. Examples of outstanding customer invoices, credit sales, balances. Account payable represents the amount of businesses owes to suppliers for goods or services purchased on credit. It is classified as current liability on the balance sheet as it must be settled within a short period. Major examples are suppliers' invoices, outstanding bills. Depreciation and liquidity. Depreciation is the process of allocating the cost of tangible assets over its useful life. This concept helps businesses account for the gradual reduction in the asset's value due to wear and tear or obsolescence. Uh, Examples: depreciation on machinery, equipment, and buildings. Uh, Next one is liquidity. Liquidity refers to a business ability to meet short-term financial obligations. Companies with high liquidity can easily pay their debts without financial strain. Example of liquid assets are cash, accounts receivable, and marketable securities. Next, any questions so far if anyone is there? Okay, next are accruals and budgeting. Accruals are accounting adjustments made for revenues or expenses that have been earned or incurred but not yet recorded. This ensures that financial statements accurately reflect a company's financial position. Examples: accrued salaries, interest payable, and unpaid expenses. Budgeting in is the process of planning financial resources for a future period. It helps businesses set targets for revenue and expenses, ensures effective financial management. Examples are sales budget, operating budget, and capital budget. Right, fiscal area. Any comments on this? Anybody, if anyone is there, can tell me about fiscal area years? Okay, fiscal year is a 12-month accounting period used for financial reporting and tax purposes. It may or may not align with the calendar year, January 1st till December 31st. Many companies choose a fiscal year that aligns with their business cycle. Examples: January 1st till December 31st, or April 1st till 31st March. Right, here is a different type of businesses. Uh, Sole proprietor is the most straightforward form of business. It is owned and operated by a single person, meaning there is a no legal distinction between the business and the owner. This structure is easy to set up and require minimal legal formalities. The owners enjoy full control over decision making and keeps all the profits. However, one major drawback is unlimited personal liability. So, if the business incurs debts, the owner is personally responsible for paying them. Additionally, raising capital can be challenging and transferring ownership is not always simple. Partnership and limited liability partnership. Uh, partnership A partnership involves two or more people who share profits, loss, and responsibilities. So, according to a legal agreement, this structure allows for greater capital investment and combined expertise, making decisions, making more collaborative. However, partners are usually jointly liable for debts, meaning if one partner fails to meet obligations, the other must cover the shortfall. Conflicts between partners can also raise, so having a clear partnership agreement is important. Limited liability partnership, version of general partnership, unlike a standard partnership. Uh, an LLP provides limited liabilities protection to its partners. This business beyond their investments. Limited liabilities partnerships are commonly used in uh, professions such as law firm, accounting firm, and consulting businesses. Benefits of and limited liability partnerships include shared management, reduced personal risk, and operational flexibility. However, setting up and limited liability partnership can be more complex than a traditional partnership, and in some countries, it is restricted to specific industries. Any questions so far? Uh, Different forms of business: limited liabilities company and corporation. We have the limited liability company. This business structure is popular because it combines the benefits of a partnership and corporation. Owners, known as members, are not personally liable for company debts, providing protection similar to corporation. At the same time, LLC offer flexibility in management and taxations, as profit can be directly passed on to members without being taxed at the corporate level. But setting up a limited liability company can involve higher costs and administrative formalities compared to a sole proprietorship or a partnership. Corporation, corporation, C corporation, and S corporation. A corporation is a legal entity separate from its owners, known as shareholders. This means that the businesses itself can own assets, enter into contracts, and be held legally possible for its actions. So corporations are managed by a board of directors and requires uh, compliance with regulatory requirements. One of the biggest advantage of a corporation is limited liability. Shareholders are also responsible for the amount they invest and are not personally liable for corporate debts. Additionally, corporations can raise large number of capital by selling shares to investors, making them attractive for example, for expansions. So, but corporation face double taxation, where profits are taxed at both the corporate level and when distributed as dividends to shareholders. So, S section, a variation of the standard corporation, is the S corporations, which is specifically designed to avoid double taxation. Instead to paying corporate taxes, profit and losses are passed directly to shareholders. Personal income similar to an LLC. S corporation have restricted to and the number of shareholders and type of stock they can issue, making them less flexible than regular corporations. Non-profit organization is business entity that operate to serve a charitable, educational, religious, or public service purpose rather than to generate profit for owners. These organizations are tax exempt and often rely on donations, grants, and fundraising efforts to support their missions. Advantage: tax exemptions, eligibility for grants and donations, and limited liability for directors and officers. Disadvantages: strict compliance and reporting requirements, limited profit distribution, and often a reliant on donations and grants. Cooperative. So, cooperative, which is unique because it's owned and operated by its members for mutual benefit. So, co-ops are commonly found in industries such as agriculture, retails, and housing. Members shares decision-making responsibilities and profits, with each members having equal voting rights regardless of their level of investment. Corporations promote democratic control and shared benefits, but they often struggle with limited access to capital and slower decision making due to their collective structure. Here, some references for you. So that's it for today. I hope this is quite useful for you. So that conclude our session for today. I appreciate your time and attention as we introduced the fundamental concept of economics and accounting. So our next lecture is tomorrow at 6:30, and in our next lecture we will discuss the key economic principle and their impact on business operations. So, thank you very much, everyone. By then, if you have any questions or need any clarification, comments, or issues, please drop me an email uh, or reach out to me at yasirgulfraz@yahoo.com or yasir at yasir at uh, UK. Thank you very much, and I look forward to seeing you in the next lecture tomorrow at 6:30. Thanks and bye for now.